Cranking up the heat a little bit. Oh, it feels good. In late January, the last day of January. And hi everybody, and welcome to the EcoInvestment update for January 31st, 2016. And where did the month of January go? And a lot of people would say good riddance. With months like we had in January, who needs anything else, right? We should have another month like that. But it ended on a good note. As I said last week, I talked about last week's. If you go back and listen to that, you'll see that I've basically taken a position in the market. I'm not expecting a bull market here. I'm expecting a trading rally and probably up to the 16,600 to possibly 17,000 level before we turn down again. Now, you know, a lot of people have written me, they were shocked. Well, you just turned on a dime like that. Well, traders do that. I mean, I'm trading in and out. I'm not holding long-term investments. If I was doing things for the long term, I'd still be sitting on the sidelines and things because we're on a red signal here. And the only thing that's going to turn that green is if this market breaks out to a new all-time high. And once again, our original working thesis will be in place that which thesis says that only rising interest rates will kill a bull market. Well, we've got the exact opposite thing going on in the world. We've got negative interest rates. And last Thursday evening, the Bank of Japan came out and suddenly announced that they were going to adopt a negative interest rate policy. And a lot of people are confused as to what that means. Well, it means if you want to put commercial deposits, if you're a member bank of the network, which I guess you're required to be in Japan, then anything above your required reserves, in other words, what you're required to have by law to back up your loans, whether it's 25% of your loan values or, you know, there's all that fractional lending and all that they do. But anything held at the Bank of Japan above that required by law for your statutory reserves to protect your depositor base and things, you will be charged a rate as if you're using the bank as a safekeeping house and not as a place to take the money, give you a little bit of return and then lend it on elsewhere. Why are they doing this? Because worldwide, banks are just being flooded with money that they have no place to put it. The commercial lending opportunities continue to dry up in places like retailing and energy. There's just a lot of sectors that are in contraction now. Biomedical is starting to hit a contraction here. So banks are left in a really ugly situation of having too much money and not enough places to put it. So it aggravates their ability to make money too, because if they don't have any place to put the money and they have to give something to the depositors, well, guess what? They're losing on both ends, because not only do they have to keep the depositor money safe and keep the bookkeeping and all the entries and all the statements that get mailed out, they also have to figure out what to do with the money to make money on it. And now, with the Bank of Japan effectively saying, don't bring that excess money to us anymore. We're not even going to pay you 1/4% interest on it anymore. You're going to pay us 1/4% interest to keep your money here on deposits. Now you have a really tough situation if you're in banking. And the thought is, and the thinking amongst the Federal Reserve, and Ben Bernanke was one of the pioneering ones of this kind of thought, was that if you can force banks to not hold money and use their excess reserves to put on deposit at places like the Federal Reserve, then by de facto, by default, they will be forced to put that money to work in the economy. So we shall see how that holds true. They've had negative interest rates in Switzerland and another Scandinavian country. So Japan was really the biggest country so far to step up to the plate. And of course the markets took off on that news because it shows that the that the Bank of Japan, the World Economic Conference in Davos, and the Federal Reserve, they're all trying desperately to restart this engine of global growth. And if you saw U.S. fourth quarter GDP, it was less than 1% growth. Okay, things are slowing down appreciably, and January will probably reflect that more so as we go into the first quarter. So they are what? They're nervous. Of course they're nervous because they've done all that they can do with low interest rates. Now they're really pushing the envelope to uncharted territory, to doing this thing called negative interest rates. So of course the markets are excited about this they're excited about this change of direction, and maybe it'll be the savior, maybe it'll be the cavalry that comes over the hill and save the markets. And I think to myself, no, it could be the thing that becomes the final nail in the coffin for a lot of these banks, and a lot of banks will have to shutter or else start making very poor loans because they won't have places to put the money. So they got this Sarbanes-Oxley and all these other banking rules that have kind of tied their hands since that big crack up in 2008. So making money in banking is not as easy as it used to be. No wonder they want to put credit cards in your hands, okay? So I thought that in light of that rally, which was to be expected, the real issue is how far do we go now? And I've already elaborated the parameters of what I think the market was due for in the way of a reflex rally. So I will still be aboard just as a trader a bit longer here. Now let's examine the evidence of what faces a central bank. And we'll talk about the Federal Reserve. These cross currents that are in the market. On the one hand, you got these pluses that have been pluses till now. Relatively decent employment, but very low level employment. There aren't factories opening up. There aren't really good wage positions opening up. And with what's going on in energy now, there's a lot of people being laid off from pretty decent jobs, and that's really, it's really a bullet that's really hurt here. Auto sales and home sales have been relatively decent, and the Fed tried to reassure people with doing that little itsy bitsy interest rate rise, not this time, but the last time, to try to send the message that it's all clear and things are looking good ahead. Well, guess what? At the last meeting, they didn't raise rates. They're seeing the ugly icebergs ahead, right? So there's still that big faith in the power of government to make prosperity, and that feeling that low interest rates will somehow, someday, create wealth. And of course, as you and I know, economic opportunities are what creates wealth. The birth of new industries, things like that. Not just shoveling money to people and saying, here, it's hot potato, you do something with it. Right? This is how bad and poor investments are made. And this is how capitalist economies are occasionally forced to go into these grinding cycles of cleaning and clearing out the dead wood, because in a Darwinian way, those that can't hack it and those that don't see the opportunities coming and don't husband their cash and aren't careful tend to disappear by the wayside. So we got minuses here too, and I know this is a long one today, but I hope you think it's worth it. We're having currency wars like the 1930s. We had the same thing with them, with countries trying to devalue their currencies in order to increase their exports and things, that beggar thy neighbor. Well, I haven't heard it mentioned anywhere else, but I have this funny feeling that as clever as the Chinese are, I wouldn't be surprised if they manufactured this whole yuan weakness and this crisis in China just to let the yuan devalue to a point where it could be a real fill-up or a real energizer for their growth. You got to think on a chessboard, a multi-dimensional chessboard. You have to look at something that's happening and you have to go past the obvious and think, what could be a motivation for having this go down, the value of the yuan? Well, of course, it's going to help help buffer up their exports. Japan moving to negative interest rates, like some of Europe. I mean, this is a distinct negative. We don't want your stinking money, okay? It's like there's no such thing as even a hint of having the virtues of thrift and saving anymore. It's like, forget it. You know, nobody wants your money. Don't save your money, spend it. I mean, these are starting to become very warped values in the system, and this is what negative interest rates get us. There's a trail of declining revenues with many big multinational companies. We've talked about the IBMs. We've talked about the Macy's, the Sears, the retailing, the Caterpillar. Even Apple is experiencing for the first time slowdowns, with the chairman of Apple talking about he sees trading conditions unlike he's ever seen before in the history. So companies are trying to hold their profits up by cutting their costs as much as possible, but their businesses, their revenues aren't growing unless you happen to be in some of those social networking, the Facebooks and the things like that. Long-term rates in the United States are plunging again on this negative interest rate breakout in the world. The 10-year note is back to 1.9293% again. I mean, if we're going to go to an era of negative interest rates, you could really see a drop in, you could see zero across the board or worse. So people were thinking, well, you know, maybe 2%, 1.92% is better than nothing. As I mentioned, GDP is basically dead at 0.7% growth, and stock markets are very volatile and dangerous. People are trend followers now. If the market goes down, the headlines and the headlines are negative and people are scared. If the market rallies like the 400 points on Friday, everybody suddenly feels bullish, and well, we have a new era now, negative interest rates, and all is right with the world. We don't have any sense that anybody really knows where we're steering right now, and that's very disconcerting to people to think about this stuff on a daily basis. And let's face it too, the political climate worldwide is really lousy right now. I mean, it doesn't need any further explanation. These are not the times of the 90s, the 2000s. These are not go-go times. These are in a lot of ways seriously depressing times. So let's net it all out. Let's add it all together, subtract it, add it, multiply it, and divide it, and we get that. We've got whipsawing markets here that are even baffling the professionals, okay, which is not unusual. There's no special skill the professionals have, okay, but they're more baffled than usual here. But people are thinking like things like crashes and stuff, they're going to happen over a period of weeks. Markets unfold over a period of months and years. And when you've had a big rise from 2008 in March of 2008 up to 18,400 or whatever, and then we have our first drop down to 1,500 something, then a rally up to 17,400. You know, people aren't going to give up the bull market easily, right? So, and there's a chance we still could be in a bull market when all is said and done. You got to keep your thinking open. But the preponderance of evidence now is things are weakening, and the news is not going to be good on balance going forward, and that's going to do very little to reinforce bullishness, and it's going to increase the feeling of negativism. And in that type of situation, you really don't want to be really a big bull on stocks. So this trend is going to unfold over weeks, years, and months. And you take your chances, like I do once in a while, to hop aboard when things get a little overstretched on the downside or the upside, to take a little counter position and make a few dollars. So it's early days in this economic downturn, I believe, and it's always tempting to think about a crash scenario. but it's likely something that's going to unfold in the weeks and months ahead, and not tomorrow. Why? Because it takes time to shift opinions, and big money doesn't move on a dime. It's considered, it sits there and thinks about all of its options, but opinion has turned a lot since the glory days of early December and the Santa Claus rally. Well, this was our longest EcoInvestment update. I hope you found it enjoyable. It covered a lot of ground here. I hope you find some food for thought on that. I never like to sound shrill. I always like to consider both sides of the argument and shift and move accordingly. You know, it's kind of like a prize fighter. You want to maintain your balance. You don't want to get caught too heavy thinking one way or another. Well, I'll see you in February, and we'll say goodbye to this stinky month of January. So thanks for being along, everyone, and have a wonderful, wonderful week. Thank you.